In my mind, I'm gone to Carolina. Can't you see the sunshine?
Greetings and welcome back to Fisher Wealth Management Tips of the Week. The financial crisis of 2008 seems like a long time ago. During that crisis, we saw the collapse of Lehman Brothers, bank bailouts, forced mergers, massive federal stimulus, extraordinary Federal Reserve policy. We experienced nearly unprecedented stock market volatility when daily market moves of 5% or more were not uncommon. Despite these extreme conditions, one of the greatest six-year bull markets emerged from this crisis. Now, we're celebrating another belated birthday of that bull market that began on March 9th, 2009. You remember, a bull market is defined as a prolonged period of stock market gains without a 20% or greater period of decline. So not only has this bull market for stocks lasted a long time from a historical perspective, by the way, it's the third longest since World War II, it's also been the strongest six-year-old bull market since the Second World War. As the bull market enters its seventh year, many are wondering whether this bull has another year left to run or not. As should not be surprising given its age and the strong returns that it has produced, this bull market may be due for a modest correction. But that doesn't necessarily mean that this downturn is imminent. Remember, risks always loom somewhere, and right now they're most likely in the form of terrorist activity, the Russia-Ukraine conflict, the possibility of a nuclear Iran, the energy downturn, and the struggles that continue in the European Union. However, there seem to be enough factors supporting this bull that it could continue its charge. You remember, bull markets do not die of old age. They typically die on excess. And there does not seem to be any evidence today that economic excesses are emerging in the United States economy. The Fed typically reacts to built-up excess with a series of multiple rate hikes, which typically contributes to the start of economic recession. The slow economic recovery we have experienced has delayed the formation of excess and the start of the Fed's rate hike campaign. Although stock valuations are slightly expensive by historical standards, prior bull markets have shown that corporate earnings can gain and they can lift stocks for quite some time, even after valuations have slightly exceeded long-term averages. Valuations have proven to be good indicators of long-term stock performance. They have not been reliable short-term indicators, however. And if low inflation persists, which helps increase the value of future earnings and dividends, economic and market indicators that have found to be effective in signaling recessions and stock downturns suggest that the economic expansion and bull market have the potential to continue well through 2015. So, given this backdrop, we believe remaining fully invested in a diversified portfolio is prudent. The outlook continues to be positive for both our economy and modest gains in stocks based on the other underlying strength of the U.S. economy, a rapidly improving employment picture, and accommodating global bank policies. Thus, we can be optimistic that we may be blowing out 7 candles on this bull market's birthday cake next year. So, as always, if you're not having these types of conversation with your advisor of choice, I welcome you to call me or one of our financial planners here at Fisher Wealth Management. So thanks again for tuning in, and stay tuned for more Fisher Wealth Management Tips of the Week.